If you invest for the long term, daily price noise feels unbearable. You wake up, check the chart, and your conviction quietly erodes. You start doubting everything. One red candle and your thesis suddenly feels wrong. One green candle and you fear that you already missed it. The same asset, the same fundamentals, completely different emotions. Most people think the problem is volatility, but the deeper issue is time frame. We live long term, yet we stare at markets in short bursts. That mismatch quietly breaks our decision making. When your screen shows 5-minute candles, your brain shrinks its horizon. The next hour feels more important than the next decade. You begin to confuse motion with meaning. You did not start with that mindset. You probably began with a calm statement about the future. Maybe you said, "This asset could matter in 10 years." But your daily behavior slowly rewires that original frame. Every notification pulls you back into the present tick. Every micro move looks like a signal, not just random noise. Your nervous system becomes tethered to each fluctuation. Over time, you stop asking, "Is my long-term thesis intact?" You only ask, "Why is price not doing what I want today?" That question sounds rational, but it is a trap. This episode is about escaping that trap. We will not remove volatility. We will rebuild how you relate to it. When you change the time frame, you change the story your brain hears. A yearly chart often looks like a slow evolving narrative. A 5-minute chart looks like a war zone. On the higher time frame, trends emerge from the noise. You see big cycles, policy shifts, adoption curves, macro regimes. Things look messy but understandable. Drop to the intraday chart and everything feels urgent. You see spikes, wicks, fake breakouts, micro panics. Your nervous system treats each move like breaking news. The asset did not change in those few seconds. The fundamentals did not update 12 times per hour. Only your lens changed, and your emotions followed. This is time frame distortion in practice. Your original plan might use a multi-year horizon, but your daily behavior is anchored to micro moves. The brain is not neutral to that conflict. It quietly rewrites your narrative to reduce discomfort. Instead of, "I am a long-term investor," you think, "I must respond to short-term danger before everyone else." Your risk perception starts to drift. A normal pullback suddenly feels like structural collapse. A small rally feels like the last train leaving. You also begin to misread randomness as intention. Every dip becomes manipulation by unseen players. Every pump becomes proof of secret insider knowledge. The more you stare at short-term charts, the worse it gets. You never give your mind enough distance to recalibrate. You live inside the zoomed-in view. A simple test exposes this distortion. Take a painful chart and switch to the weekly time frame. Hide everything except the last 3 years of candles. Ask yourself a quiet question. If I only saw this view, would my thesis really change? Most of the time, the answer is no. That gap between feeling and evidence is the real problem. Time frame distortion does not merely confuse your eyes. It reprograms your identity as an investor. Volatility is not just a market feature. It is a psychological engine. It powers a loop inside your brain. Every sharp move creates a small emotional spike. Your nervous system reads it as threat or opportunity. Both signals feel urgent and important. When price moves fast, your brain releases dopamine, not only when you profit, but simply when things change. Change itself becomes addictive stimulation. You begin to crave updates more than outcomes. You care less about long-term results. You care more about not missing the next jolt. Checking the chart becomes a micro hit. Even when nothing meaningful has changed, you still feel a brief surge of tension. Then comes relief when price stabilizes. Your brain quietly reinforces the checking behavior. It says, "This action reduces uncertainty and pain." Soon you are not monitoring a position. You are feeding a habit loop. Cue. Action. Reward. Repeat. The cue is simple. Uncertainty about price direction. The action is to open the app again. The reward is emotional, not financial. Sometimes the reward is hope after a green candle. Sometimes it is clarity after a red one. Either way, the loop strengthens itself. This pattern erodes your ability to sit still. Patience feels like negligence, not discipline. Doing nothing feels irresponsible during volatility. So you start making small impulsive moves. You trim winners for no structural reason. You add to losers from pure frustration. Each impulsive trade gives another dopamine hit. Your brain confuses relief with skill. It believes that acting equals controlling risk. The problem is subtle but dangerous. Volatility is not just moving price around. It is moving your emotional baseline closer to anxiety. Over time, your tolerance for calm shrinks. Flat markets feel dead and meaningless. You seek drama to feel alive again. At that point, the market owns your attention. You are no longer designing a long-term journey. You are reacting to an endless stream of stimuli. Escaping this loop requires more than willpower. It demands a different relationship with information flow and a new anchor for your decisions. That anchor is process, not price. A healthy investor does not worship price. They respect it, but they do not obey every tick. Their primary allegiance is to a process. A process is a predefined way of deciding. It includes how you size positions over time. It defines how you measure risk and conviction. It also defines when you will do nothing. That part is often missing. Yet in long-term investing, inaction is a core action. Process first means you decide your rules when calm. You write them down away from the flashing screen. You specify your time horizon for each position. You also define your reasons to exit beforehand. Structural reasons, not emotional ones. Examples are broken thesis, forced liquidity, or better opportunity. Once that framework exists, daily price becomes context. It is one input among many, not the master variable. You check whether new information truly hits your framework. If a move does not touch your core thesis, you label it noise. You still feel it, but you do not let it steer decisions. You respond with observation, not immediate action. A useful mental shift is this. You are not here to predict each swing. You are here to behave well across many cycles. That changes which questions you ask. Instead of, what will price do this week? You ask, is my current behavior aligned with my process? You grade yourself on process adherence, not just on recent profit or loss. Sometimes the correct action will still lose money. Accepting that reality is part of maturity. Markets are probabilistic, not a moral scorecard. Good decisions can lead to short-term pain. If you only reward yourself when trades win, you corrupt your process. You start bending rules to chase emotional relief. You want to feel smart today, not consistent over time. Process first means you celebrate different milestones. You celebrate holding through normal volatility with intact thesis. You celebrate passing on setups that do not fit your criteria. You also celebrate closing a position when your thesis truly breaks. Not because the chart looks ugly this morning, but because the underlying story has fundamentally changed. Over months, this rewires your relationship with volatility. You still see fast moves and sudden shocks, but you evaluate them through a stable internal filter. The market remains chaotic on the surface. Your responses become quieter and more deliberate. That gap is where long-term edge is born. Most investors try to fix price instead of fixing perspective. They believe stability comes when markets calm down and move smoothly. Reality works the other way. Markets rarely stay calm for long stretches. Volatility is the rent you pay for long-term upside. Stability must come from your internal framework instead. You can think of 3 layers around every position. The outer layer is daily price and short-term sentiment. The middle layer is macro context and sector conditions. The inner layer is your thesis, time frame, and sizing. Most anxiety comes from living in the outer layer. You refresh price but ignore the deeper structure. You react to each tick like a life-changing event. Reframing starts by reversing that order intentionally. You begin every review from the inside out. You ask first, has my thesis actually changed? If the thesis is intact, you move one step outward. You ask, has the macro or sector backdrop structurally shifted? Only then do you look at the latest price action. This simple sequence slows your thinking down. It forces your brain to consult the full context. Price becomes a data point, not a dictator. The second part of reframing is time discipline. You choose how often each layer deserves attention. Different layers need different review frequencies. Your core thesis might need review quarterly, not daily. Macro conditions may deserve a monthly deep dive. Short-term price can be checked on a preset schedule. You decide that schedule when you are calm. For example, once per day at a fixed time, or twice per week, with deliberate reflection afterward. The important point is this. You are not checking price whenever anxiety appears. You are checking it as part of a designed routine. This breaks the unconscious dopamine loop. Your brain stops linking every emotion to instant action. You create space between feeling and response. Over time, a different identity takes shape. You no longer see yourself as a hostage of volatility. You see yourself as a curator of decisions across cycles. You will still feel fear during drawdowns. You will still feel excitement during strong rallies. But these emotions become weather, not commands. On the surface, nothing has changed. The same candles, news, and narratives still appear. Underneath, your relationship with all of them is different. You move from price first to process first, from reacting to every tick to honoring your time frame, from chasing certainty to managing uncertainty with intention. That shift does not happen overnight. It is built through many small, boring repetitions. You practice holding your frame while the market moves. One day you realize something subtle. You still care about performance, but not every wiggle. You are finally playing the game you intended to play.